Ladies and gentlemen, if you think you can walk into your bank right now and withdraw your own money without being questioned, tracked, or blocked, you're living in a fantasy. The financial system has officially entered a new phase, a phase where your access to your own cash is no longer a right, it is a privilege that can be revoked at any moment. And the scariest part is that most people have absolutely no idea this is happening. Let me be very clear about what I am about to tell you. This is not a conspiracy theory. This is not fear-mongering. This is documented policy that went into effect just 4 weeks ago on January 1st, 2026. The Internal Revenue Service, working in coordination with the Department of Treasury and FinCEN, has implemented a new surveillance system that monitors every single cash withdrawal you make over $1,000. Not $10,000, not $5,000, $1,000. That is the new threshold where the government demands to know what you're doing with your own money. Think about that for a moment. $1,000. That is less than a month's rent for most people. That is less than a car payment and insurance combined. That is barely enough to buy groceries for a family of 4 for 3 weeks. And the government has decided that if you need to withdraw that amount in cash, you are now a person of interest. You're now someone who requires monitoring, tracking, and potential investigation. But here is what they are not telling you. This is not about catching criminals. This is not about stopping money laundering or tax evasion. This is about control. This is about the government slowly, methodically, systematically restricting your access to physical currency because they know what is coming. They know the system is breaking. They know the dollar is dying. And they need to make sure that when the panic starts, when people finally wake up and try to pull their money out of the banks, those people will be stopped at the door. The official policy document states that any withdrawal between $1,000 and $10,000 will now be reported to FinCEN, the Financial Crimes Enforcement Network. The bank is required to log the transaction, identify the individual, record the purpose of the withdrawal, and submit a detailed report if the pattern appears suspicious. And here is the key word, suspicious. They do not define what suspicious means. They do not give you a clear set of rules. They leave it deliberately vague so that any withdrawal for any reason can be flagged if they decide they do not like it. And before you say, well, I do not withdraw large amounts, so this does not affect me, let me explain how this actually works in practice. Because the $1,000 threshold is just the trigger point. Once you cross that threshold once, your account is marked. Every subsequent withdrawal, even if it is $500, even if it is $300, gets added to your profile. The system is looking for patterns. It is looking for people who are trying to avoid the limit by making multiple smaller withdrawals. They call this structuring. And it is technically illegal under federal law, even if you are withdrawing your own money for completely legitimate purposes. Let me give you a real example that is happening right now across the country. A small business owner goes to his bank on Monday and withdraws $900 in cash to pay his contractors who prefer cash payment. On Wednesday, he withdraws another $800 for the same reason. On Friday, he withdraws $700, 3 separate transactions, none of them over the $1,000 limit, total amount $2,400 over 1 week. The bank's automated system flags this as potential structuring. Within 72 hours, FinCEN receives a suspicious activity report. Within 2 weeks, the IRS opens a preliminary inquiry. The business owner has no idea any of this is happening. He has done nothing wrong. He has violated no law. He is simply running his business the way he always has. But now he is in the system. And once you are in the system, you stay in the system. Now, some of you might be thinking, okay, but I can just use my debit card or write checks, so I do not need cash anyway. And that is exactly what they want you to think. Because the end game here is not just monitoring cash withdrawals. The end game is eliminating cash entirely. It is forcing you into a completely digital system where every single transaction you make can be tracked, recorded, analyzed, and if necessary, blocked. And we are already seeing the infrastructure for this being built right now. On January 16th, 2026, just 13 days ago, the Federal Reserve announced an expansion of the FedNow instant payment system. This is the central bank digital currency infrastructure that they have been building for the past 3 years. They are calling it a faster payment system. They are selling it as a convenience. But what it really is a control mechanism. It is the ability for the government to see every dollar you spend, every transaction you make, in real time, and more importantly, it is the ability to turn off your access to money with a single keystroke. Think about what that means. Right now, if you have cash in your hand, that cash is yours. You can spend it wherever you want. You can save it under your mattress. You can give it to your kids. You can buy whatever you choose without anyone's permission. But in a fully digital system, every transaction requires approval from the network. And if the network decides, for whatever reason, that your transaction is not authorized, you cannot complete it. Your money becomes worthless in your hands. You might have $1 million in your account, but if the system says no, you cannot buy a loaf of bread. This is not theoretical. This is not some distant dystopian future. This is happening in other countries right now. In Nigeria, the government launched a central bank digital currency called the Naira in 2021. Within 18 months, they restricted cash withdrawals to $100 per day per person. The official reason was to encourage digital adoption. The real reason was capital control. When people started protesting, when people started demanding their cash, the government simply said, "We are modernizing the economy. Adapt or suffer." In India, in 2016, the government executed something called demonetization. Overnight, they declared that 86% of all cash in circulation was no longer legal tender. They gave people a few weeks to deposit their old currency into banks and receive new currency in return. The stated goal was to fight corruption and black money. The real result was economic chaos. Small businesses collapsed. Poor people who had saved cash under their beds for decades watched their life savings become worthless paper. And the government used the crisis to push people into digital payment systems where every transaction could be monitored. This is the playbook. Create a crisis, offer a solution, and use the solution to implement control. And we are watching the exact same playbook unfold in the United States right now. Let me show you the timeline. Let me show you how the trap is being set step by step, month by month, so you can see where this is going and understand why you have a very small window of time to act. Phase 1 began in April 2020 when the Federal Reserve suspended Regulation D. This was the rule that limited you to 6 convenient withdrawals per month from your savings account. The Fed announced they were suspending the rule to give people more flexibility during the pandemic. Most people thought this was a good thing. What they did not tell you is that while the federal rule was suspended, the banks were allowed to keep their own restrictions in place. And almost every major bank in America did exactly that. They kept the 6 withdrawal limit. Some even reduced it. Why? Because banks do not want you taking money out. They want your money locked in their system where they can use it, lend it, leverage it. And by keeping withdrawal restrictions in place while claiming they removed them, they conditioned people to accept limits as normal. Phase 2 started in January 2023 after the collapse of Silicon Valley Bank, Signature Bank, and First Republic Bank. These 3 banks held a combined $542 billion in assets. When they failed within 6 weeks of each other, it exposed the core vulnerability of the fractional reserve banking system. The banks did not have the cash to cover withdrawals. They had loaned it out, invested it, leveraged it, and when depositors demanded their money, the banks could not provide it. The FDIC had to step in with emergency measures. They guaranteed deposits above the $250,000 insurance limit. They provided unlimited liquidity to prevent a complete bank run. But here is what most people missed. In the aftermath of that crisis, the Fed and the FDIC implemented new stress testing requirements for regional banks. These requirements forced banks to maintain higher liquidity ratios. But higher liquidity ratios mean less lending. Less lending means slower economic growth. And to avoid slower growth, the banks found a different solution: restrict withdrawals. Phase 3 began in October 2025, when the Joint Economic Committee released a report showing that the national debt had crossed $38 trillion. The report included a devastating statistic. The United States government is now paying more in interest on the debt than it spends on national defense. Interest payments in fiscal year 2025 totaled $1.22 trillion. Defense spending was $790 billion. Let me repeat that. The government is spending more money just to service the debt, just to pay interest, than it spends on the entire military, every soldier, every tank, every aircraft carrier, every weapon system. That is not sustainable. That is not manageable. That is a death spiral. And the Congressional Budget Office has already projected where this goes. By 2028, interest payments will consume 14.52% of all federal spending. By 2030, it will be over 17%. At that point, the government faces an impossible choice: default on the debt, cut essential services, or print money to cover the gap. We all know which option they will choose. They will print. They will inflate. They will devalue the currency. And when they do, the buying power of your dollars will evaporate. This brings us to Phase 4, which started on January 1st, 2026, the $1,000 withdrawal monitoring system I told you about earlier. But there is more to this phase than just monitoring. There is active restriction happening right now that almost nobody is talking about. As of today, January 29, 2026, the average ATM withdrawal limit across major U.S. banks has been quietly reduced. Just 2 years ago, the average limit was $1,000 per day. Today, it is between $500 and $800 depending on your bank and account type. PNC Bank has a limit of $500 for standard checking accounts. Bank of America ranges from $700 to $1,000 depending on account tier. Chase has reduced its standard limit to $800. Wells Fargo caps most accounts at $700. U.S. Bank is at $500 for new accounts. Think about what this means in practice. If you need $2,000 in cash for an emergency, you cannot get it from an ATM. You have to go into a branch during business hours. And when you go into the branch and request $2,000, the teller is required to ask you what the money is for. They are required to log the reason. They are required to submit documentation if the amount seems inconsistent with your normal banking activity. You're being interrogated for accessing your own money. And here is where it gets even more insidious. Multiple banks have begun implementing what they call cash delivery delays for large withdrawals. If you want to withdraw more than $5,000 in cash, you now have to call ahead and give the bank 24 to 72 hours notice. They claim this is for security reasons, to make sure they have enough cash on hand. The real reason is to give them time to evaluate whether they want to allow the withdrawal at all. Because under current banking regulations, if a withdrawal is deemed suspicious, if it raises red flags in their system, the bank can refuse to complete the transaction and file a suspicious activity report without ever telling you why. Let me tell you what happened to a small business owner in Ohio just last week. I have seen the documentation. This is a real case. The owner needed $12,000 in cash to purchase equipment from a private seller. He called his bank, Chase, and requested the withdrawal. The bank told him they needed 3 business days' notice. He said fine and scheduled the withdrawal for the following Monday. On Monday, he arrived at the branch to pick up the cash. The branch manager informed him that the withdrawal had been flagged by their compliance department and that he would need to provide documentation proving the purpose of the withdrawal. He showed them the bill of sale for the equipment. They said they needed to verify the legitimacy of the seller. He provided the seller's business license and tax ID. They said they would need to hold the withdrawal pending additional review. No time frame was given. No explanation was provided. His money was being held hostage and there was nothing he could do about it. This is not an isolated incident. This is becoming standard operating procedure. Banks are using anti-money laundering regulations, know your customer requirements, and suspicious activity reporting as weapons to control access to cash. And they are doing it with the full backing of federal regulators. Now let me show you why this matters right now. Let me connect this to what is happening in the precious metals markets, because this is where the government's desperation becomes undeniable. As of 8 o'clock this morning, Eastern Time, January 29, 2026, silver is trading at $118.04 per ounce. Let me put that in perspective for you. 1 year ago, on January 29, 2025, silver was trading at $30.43 per ounce. That is an increase of 274% in exactly 1 year. This is not normal market behavior. This is not a bull market. This is a panic stampede out of paper currency and into hard assets. People who understand what is happening are converting their dollars into physical metal as fast as they possibly can because they know the paper is dying. And silver is not alone. Gold as of this morning is trading at $5,537.92 per ounce. 1 year ago, it was $2,763. That is almost exactly double. A 100% gain in 1 year for the world's oldest store of value. When gold doubles in a year, when silver goes up 274% in a year, that is not because people suddenly decided precious metals are pretty. That is because people are fleeing the dollar. That is because the smart money, the informed money, the institutional money, is getting out of paper and into physical assets before the door closes. And the door is closing. That is what the withdrawal restrictions are really about. The government knows that if people wake up all at once, if even 10% of Americans decide they want to pull their money out of banks and convert it to cash or gold or silver, the entire system collapses immediately. The banks do not have the money. They never did. It is a fractional reserve system. For every dollar you think you have in your account, the bank only holds 10 cents in actual reserves. The rest has been loaned out, invested, leveraged, hypothecated. And if everyone asks for their money at the same time, the math does not work. This is why they are implementing withdrawal limits now, before the crisis, before the panic. They are setting up the infrastructure of capital controls while people are still calm, while people are still trusting, while people are not paying attention. And by the time people realize what is happening, by the time they try to get their money out, the restrictions will already be in place, and they will be trapped. Let me show you the numbers. The total amount of currency in circulation in the United States is approximately $2.3 trillion. That includes all physical cash, all paper bills and coins. But the total amount of money in checking accounts, savings accounts, and money market accounts is over $18 trillion. That means there is $18 trillion of digital money backed by only $2.3 trillion of physical currency. That is a ratio of almost 8 to 1. For every $8 people think they have, only $1 actually exists in physical form. Now, what happens if people try to withdraw even 20% of their deposits? 20% of 18 trillion is $3.6 trillion, but there is only 2.3 trillion in total currency. It is mathematically impossible. The system cannot handle it. And the government knows this. The banks know this. That is why they are building the cage right now while you are not looking. And there's a second layer to this that is even more dangerous. The Federal Reserve's balance sheet as of December 31, 2025, stands at $7.2 trillion. To put that in context, before the 2008 financial crisis, the Fed's balance sheet was less than $1 trillion. They have expanded it by over 7 times in less than 20 years. And every dollar on that balance sheet represents money that was created out of thin air, money that was printed, money that dilutes the value of every dollar you hold. Interest on the national debt is now consuming $1.22 trillion per year, as I mentioned earlier. That is billion per month. That is 28.8 billion per week. That is 4.1 billion per day. That is 171 million per hour. That is 2.85 million per minute. That is $47,500 per second. Every single second that passes while you listen to this, the United States government pays $47,500 in interest on money it borrowed and can never repay. Where does that money come from? It does not come from tax revenue. Tax revenue is already fully allocated to existing programs. The interest money comes from new borrowing. The government borrows more money to pay the interest on the money it already borrowed. That is a Ponzi scheme. That is unsustainable. And everyone who understands finance knows it. This is why gold and silver are exploding. This is why the wealthy, the informed, the connected are moving their assets out of dollars and into hard assets. They know what is coming. They are not waiting for confirmation. They are not waiting for the mainstream media to tell them it is okay to panic. They are acting now while they still can. And here is the brutal truth that nobody wants to talk about. When the system finally breaks, when the currency crisis becomes undeniable, the government will not allow you to protect yourself. They will not let you just withdraw your money and convert it to gold or silver. They will implement what is called a bank holiday. They will close the banks, freeze accounts, restrict withdrawals, and implement capital controls. And while they are doing that, they will announce that precious metals are now subject to emergency requisition for national security purposes. They did it in 1933. They can do it again. On April 5th, 1933, President Franklin Roosevelt signed Executive Order 6102. This order made it illegal for any American citizen to own gold, not gold mining stocks, not gold certificates, physical gold coins, bars, bullion. The order required every American to turn in their gold to the Federal Reserve in exchange for paper dollars at a fixed rate of $20.67 per ounce. Failure to comply was punishable by a $10,000 fine and 10 years in prison. That fine in today's dollars is approximately $230,000. And here is the part that most people do not know. After the government confiscated all the gold, after they forced everyone to exchange their real money for paper promises, they revalued gold from $20.67 per ounce to $35 per ounce, a 69% increase overnight. The government stole the people's wealth, then immediately increased the value of what they stole. The people who held on to their gold illegally made a fortune. The people who complied and turned in their gold got robbed. History does not repeat, but it rhymes. And right now, the rhythm is unmistakable. Massive government debt, currency debasement, loss of confidence in paper money, rising gold and silver prices, capital controls being quietly implemented. This is the exact same pattern that played out in 1933. The only difference is the scale. In 1933, the national debt was $22.5 billion. Today, it is $38.43 trillion. That is 1,700 times larger. The crisis coming is not going to be contained. It is going to be catastrophic. And you can already see the preview of what is coming in, how they are treating cryptocurrency. In 2024, the SEC declared that most cryptocurrencies are securities and therefore subject to federal regulation. In 2025, they began requiring all crypto exchanges to report transactions over $600 to the IRS, not $10,000, $600. And in January 2026, just weeks ago, they announced that any self-custodied crypto wallet containing more than $10,000 in value must be registered with FinCEN. Self-custodied means you hold your own private keys. You're not using an exchange, you are storing your crypto yourself. And now the government is demanding that you report that to them. Do you see the pattern? They are closing every exit. They are building walls around every form of value that exists outside their control. Cash, gold, silver, crypto. Every avenue of escape is being monitored, restricted, regulated. And the reason is simple. They know the collapse is coming. They know that when people finally understand what is happening, there will be a mass exodus out of the dollar. And they cannot allow that to happen because if it does, the game is over. The dollar dies, the empire falls, and everyone who holds paper wealth loses everything. Now, let me show you what this means for you specifically. Let me walk you through the exact scenario that is coming and how you can position yourself before it is too late. Right now, today, you still have options. The system is restricting withdrawals, but it is not shut down completely. You can still go to your bank and withdraw cash, although they will ask questions if it is over $1,000. You can still buy physical silver and gold, although premiums are rising and availability is tightening. You can still convert paper assets into hard assets, but this window is closing fast, and once it closes, it will not reopen. Here's what you need to understand about the timeline. The government does not announce capital controls in advance. They do not give you warning. They implement them overnight, usually during a crisis. And by the time you wake up and realize what happened, it is too late to act. This is what happened in Greece in 2015. The government closed all the banks on a Sunday night. When people woke up Monday morning, ATMs were limited to 60 euros per day. That is about $65. $65 per day was all you could access from your own account, regardless of how much money you had. And that limit stayed in place for months. This is what happened in Cyprus in 2013. The government announced a bank holiday on Friday evening. Banks were closed for 2 weeks. When they reopened, accounts over 100,000 euros were subject to a bail-in. That is a polite term for theft. The government took 47.5% of every deposit over 100,000 euros to recapitalize the failed banks. People who had their life savings in Cypriot banks woke up one day and found that half their money was gone. No warning, no vote, no recourse. This is not ancient history. This is not theoretical. This is recent, documented, real-world precedent. And it is going to happen in the United States. The only question is when. Now here is where precious metals become your lifeboat. Physical gold and silver exist outside the banking system. They are not digital entries in a database. They are tangible assets that you hold in your hand. When banks close, when ATMs shut down, when capital controls are implemented, gold and silver still work. They still have value. They are still accepted. And most importantly, they cannot be frozen, seized, or deleted by a government keystroke. But, and this is critical, you have to get them now. You cannot wait until the crisis starts. You cannot wait until the announcement is made. By then, it is too late. The dealers will be sold out. The premiums will be astronomical. The delivery times will be measured in months, or worse, the government will have already implemented restrictions making it illegal to buy or sell without approval. Right now, as of January 29, 2026, you can still buy physical silver at $118 per ounce. Yes, that is up 274% from last year. Yes, that seems expensive if you look at historical prices, but if you understand what is coming, you realize that $118 per ounce is a gift. Because when capital controls hit, when the bank holiday is announced, when the current currency crisis goes mainstream, silver is not going to 150 or 200. It is going to 500, 1,000, maybe more. Not because silver becomes more valuable, but because the dollar becomes worthless. Think about it this way. If you have $10,000 in your checking account right now and the government implements capital controls tomorrow, how much of that money can you actually access? Under Greek-style restrictions, you might be limited to $65 per day. That means it would take you 154 days, over 5 months, to withdraw your own $10,000. And during those 5 months, inflation is eating away at the value. During those 5 months, shortages are developing. During those 5 months, you are trapped. But if you took that $10,000 today and converted it to physical silver, you would have approximately 84.7 ounces of metal. That silver is yours. It is in your possession. It cannot be frozen. It cannot be restricted. It cannot be confiscated unless they physically come to your home, break down your door, and take it by force. And yes, that happened in 1933, but it only happened to people who were on the registration list, people who had bought their gold through official channels where the government could track them. This is why privacy matters. This is why buying from reputable dealers who do not report your transactions to the IRS is so important. This is why storing your metals yourself, rather than in a bank-safe deposit box, is critical. Because when the crisis comes, the government will use every tool they have to identify, locate, and confiscate hard assets. And if you are in their system, if they know what you have, you become a target. Let me give you one final piece of evidence that proves this is not speculation. On January 8th, 2026, just 3 weeks ago, the Joint Economic Committee released their monthly debt update. The report stated that the national debt is increasing at an average rate of $8.03 billion per day, not per month, per day. That is $334.48 million per hour. That is $5.57 million per minute. That is $92,912.33 per second. While you were listening to this script, while you were sitting here trying to decide if this is real or not, the national debt increased by over $6 million. In the time it takes you to make dinner tonight, it will increase by another $1 billion. This is not sustainable. This is not manageable. This is a debt spiral that ends in currency collapse, hyperinflation, or default. There is no fourth option. There is no magical solution. The math does not allow for a happy ending. And the government knows this. The Fed knows this. The banks know this. They are preparing for the inevitable. They are building the infrastructure of control so that when the crisis hits, they can manage the collapse without losing power. Capital controls, digital currency, withdrawal restrictions, asset monitoring. This is all about control. This is all about making sure that when the system falls apart, the people in charge stay in charge, and the people at the bottom stay at the bottom. But here's the part they cannot control. They cannot control what you do right now, today, before the crisis. They cannot stop you from converting paper wealth into hard assets. They cannot prevent you from withdrawing cash, buying gold, buying silver, and storing it outside the banking system. At least not yet. They are working on it. They are building the regulations. They are closing the loopholes. But as of today, January 29, 2026, you still have the freedom to act. And that freedom has an expiration date. I'm not telling you to panic. I'm not telling you to do anything reckless. What I am telling you is to wake up. Look at the facts. Look at the timeline. Look at the policies being implemented right now while everyone is distracted by whatever crisis is dominating the news cycle. The withdrawal restrictions are real. The $1,000 monitoring is real. The ATM limits are real. The national debt spiral is real. The rising precious metals prices are real. These are not theories. These are documented facts. And if you understand these facts, if you connect the dots, there is only one logical conclusion. The system is breaking. The government is preparing for the break. And you need to prepare as well. Not tomorrow, not next week, not when it feels convenient. Now, today, while you still can. Silver at $118 per ounce is not expensive when you understand what is coming. It is cheap. It is the cheapest insurance policy you will ever buy. And unlike every other insurance policy, this one actually increases in value over time instead of costing you premiums. Gold at $5,537 per ounce is not out of reach for everyone. You can buy fractional gold. You can buy 10th ounce coins, quarter ounce coins. You can start small and build over time. But you have to start. You have to take action. Because when the window closes, when the restrictions become lockdowns, when the monitoring becomes confiscation, you will not get a second chance. The trap has been set. The cage is being built. And most people will not realize they are trapped until it is too late. Do not be most people. Be the person who saw it coming. Be the person who acted. Be the person who protected their wealth, their family, their future before the system collapsed around them. The time to decide is now. The time to act is today. Because tomorrow the rules might change. And once they change, they do not change back.